Welcome back, everyone. This section on the model building process follows on from Ned Davis's other chapter on being right or making money, where I think that was more a philosophical journey into the types of things that we need to do and the way we need to approach building a model. This is now getting a little more into the nuts and bolts of the types of things that he looks at. And so again, really great, and we'll see how he gets all of these different ideas and brings them all together into the models and works on a weight of the evidence type approach to the markets. So let's jump in here. So we've got building a timing model. Basically what he's doing is going to start with the inputs. What are the different things? He's going to look at all the different things, be it internal or external, and say, what do I want to use to, or what do I think has value to help me in building a model? And looks at those inputs. Now, of course, the model that we create is only ever as good as our inputs, be it our data, and when it comes to pricing data, is our data accurate? Is it clean? Are spikes removed? Those sorts of things. They're all the sorts of things that you need to look out for. Sometimes with some of these, especially more the fundamental data, there can be revisions. There may be an expectation of analysts, and then the analysts make a revision, and that changes. And so it's not as simple as sometimes our technical price charts. But we have to be able to understand when they happen and adapt our models, or be able to get that data into our model as quickly as possible. Is the data best for long-term positions or aggressive trading? Different types of, let's just take interest rates. The interest rates are not necessarily something that we would be trading from, but it gives us the long-term picture of, well, where do we think the market's going to go on our history and our study of interest rates in the past. And so that's more in line of saying, okay, it's a long-term thing. It helps me set the framework for my model, but I may not use it as a trading indicator on its own, or it's just one of several inputs that come into this weight of the evidence approach. And then consider the indicators: external, derived sentiment, those type of things, and internal calculations on the data or the fundamentals. All right, so there's a number of different types of indicators that Ned Davis talks about in the chapter. The advisory service opinion as a sentiment indicator is one of the classic ones. Now, they obviously use polls. They'll poll their clients, their advisors that subscribe to them, and they get a lot of research out of that. And what they found is that when the majority of those polled all have the same view, it is likely that an extreme has been reached. And again, we keep coming back to this whole supply. If everybody has the same view and everybody wants to buy, well, then nobody's out there selling. And then the price can't go higher because we've got no transactions happening. So that's a big part of why, when there's sentiment like this and you see everybody agreeing, then there's going to be a rollover. Because once the price stops rising, then you start getting people saying, oh, hang on, we better sell out of this because it's reached an extreme. And then that starts rolling over again. Valuation indicators. So this is like price per PE ratios and price to book ratios and things like that. So Ned Davis will use these in their calculations. Valuation indicators can be great sentiment indicators. The PE ratio, basically, those high values, it shows optimism despite lower yields. So if the yields are dropping, you would think that fundamental analysts would be saying, let's get out of this position, we don't want to be in there, and the price drops. But if the price remains high with low yields, it shows that there's a lot of optimism in the analysts, and they're keeping it on their books, or they're adding to their portfolios despite the high ratios there and the low yields. So that's a big part of what Ned Davis does, and the inputs into his models there is those PE ratios as well. Tools used by the Fed to adjust money supply. These are big ones that he'll watch as well. So the Fed controls money through two main ways. The first is obviously the short-term interest rates, and the second is through the supply of money. So quantitative easing and things like that. So those two ways, obviously rising rates mean lower stock prices. Talked about that many times. Bonds are more attractive. When you can get the same yield from a government bond as you can get by buying and holding shares and getting dividends from the company, well then it makes a lot more sense to be in the government bonds because the risk is gone. It basically it's getting the same return for less risk. And so that is always the big driver. When those interest rates go up, then fixed income becomes a lot more popular because for people who are on the hunt for yield. And so that's why we see those stock prices dropping. Indicators on the trend of interest rates are very useful. So be it moving averages, be it even trend lines if you were to do it manually. But having that type of analysis on interest rates and things like that, we use three-dimensional yield curves, which allow us to look at what are the near-term rates versus the long-term rates, so the yield curve, but then look at that over history. And it's amazing when you see the inversions when we get into those crazy events like 2007 and things like that, where short-term rates were paying more than the long-term rates. Doesn't make sense for the risk premium. So that's important. Now on the money supply, they can reduce supply to limit purchasing power. Obviously they can increase supply like quantitative easing. That was the Fed coming in, increasing the money supply, which then stimulates the market and boosts the buying power and the confidence in the market as well. Again, reduced money supply is bad for stocks. Increased money supply is obviously good. I really believe that we pulled out of the bear market from 07 to 09 purely because of the quantitative easing, and it would have had another leg down if it wasn't for that. So it definitely makes a difference. Economic indicator readings. So these are, again, all of these types of things like the gross domestic product, the consumer price index, surveys and things like that. So again, it's looking at those, going to the FRED database, and finding those types of surveys and those types of economic indicators and using those as inputs into the model. Typically have the most influence on bond prices and interest rates, but of course, as we've said, those things then have a flow-on effect to the equity markets. And so it's just knowing those and timing them. Are they a negative influence? Are they a positive influence? Good and bad news tends to be bad or good for bonds and stocks. Good news is likely to prompt the Fed to restrain the economy. Bad news is likely to prompt the Fed to stimulate the economy. And so we just need to know what's happening there. Moving averages, again, we're talking about these using the slope as a slope indicator. Is the price above, below, using it as a crossing indicator. Just different ways to use moving averages as we build models. And you'll know from a lot of the indicators we talked about, there's often a signal line, which is a moving average, fairly fast moving average of an indicator. We talk a lot about that in CMT2, how we can have many different ways of signaling buy and sell signals based on that as well. Obviously, we can control sensitivity of moving averages by adjusting their length. The slower moving averages, with a larger count of bars, is going to react slower, but it's more confirmed, and so there's less whipsaw going on. Can also use multiple moving averages as well, as we've all talked about already. Breadth measures, we've talked about that in confirmation and consensus. Basically, breadth thrust was one that ND research found was very, very good to use, and that's where there is you basically get a breadth measure with advanced decline, and there's a fairly consistent value. But when you get this big thrust up, and 90% is the threshold that they're using, of the investment grade stocks. Now this is something worth stopping on. Ned Davis talks about investment grade stocks. It's not the whole market, it's not all the ETFs, it's not all the equities or some of the derivatives there. It's the stocks that meet their criteria to be invested in. And that's a big part of this as well, is that when we're building a model, not only do we look at all the indicators, but again, when it comes to the data, we've got to look at what are the stocks that we're going to use in our model. What are the ones that meet the criteria that we want to invest in? For some, it may be an ethical model where you're saying, well, I'm not going to invest in companies that don't match my ethics. And that's fine. So these are the ways, the investable grade stocks is what ND Research have done. They've basically said, let's grab the ones that meet our criteria. So their testing of this was when 90% of those rise above their 50-day moving averages, then there have been no losses 1 year later. So the market continued on to make profits over the next year. So that was one that they watched there. 52-week lows, dividing it by the number of issues. So remembering these issues, the securities, when you've got stocks that are making 52-week lows and you divide that by the total number of stocks available in the investable grade stocks in this count, this is what he calls the granddaddy of breadth measures. Lots of lows like this will lead to market declines. So they're obviously watching out for that and using that again as an important input into their models. Momentum, it's a great measure of trend. We've talked about that. Thrusts in momentum, which is a really high acceleration there. It usually continues in the same direction. It's like if I throw a rock up in the air, it's maybe decelerating, but because of that initial thrust, it's going to take time for it to slow down. And the same thing happens in the market. We don't just get instant reverses of momentum. Momentum tends to then roll away and come back down again. So, these are why we watch these things and why for the short term, following a momentum thrust, there is an expectation of that equity still outperforming and being a great contributor to the model. Looking for clear reversals from high readings to indicate an objective change in momentum. We can apply to the extremes, to external. So economic indicators, putting momentum on an economic indicator is also, really powerful. So all these techniques that we put to price, we can put on these other indicators as well and start using those to help us get an inkling of, where things are going. Momentum of bonds gives good signals for stocks. Momentum of commodities gives good signals for bonds and stocks. And talking more about the intermarket process as well. So using brackets like envelopes or bands to help identify extremes as well. Next one there, weight of the evidence. Now this is not only Ned Davis, I've seen a lot of successful people do this. Greg Morris from Stadion does the same sort of approach where they have these signals and each signal comes in and they look at these and say, right, when we have got, let's say there's 9 signals in our strategy. When we've got 5 or more, then it's a buy. If there's less, then it's a sell. So it's not just relying on one indicator, but it's using this weight of the evidence and saying, hey, we have got significant confirmation across different types of measures that would lead us to want to say, we want this in our portfolio. And that's how this often works. And a lot of successful people have worked this way as well. Every indicator gets a weight given to it. So let's just say that the price is above the moving average. Well, that would have a +1 because it's bullish. Or there's a -1 because it's bearish, or there would be a neutral, 0. So if it's in a neutral phase, then no weight is added to that as well. So all those weights are added up, and you can see here just some very simple math. If there were 20 indicators, 13 were bullish, 4 bearish, and 2 in neutral, then our sum would be 9. And if that surpassed the threshold, well then that would be added into our portfolio. So we test the results against the market to make sure that this is actually is adding to us. You know, if we were to do this historically through our test period, does this give us incremental gain or not? Ideally, the model includes a variety of indicators, including trend, monetary policy, sentiment gauges, and things like that. We want diversification of our indicators. All right, key issues that we need to watch out for. We've got to watch for over-optimizing or curve fitting. You know, one of the questions I often get asked about the Optuma software is why don't we put in, you know, the optimizing or the goal-seeking type functions? And partly that's because from a technical point of view, I'm actually opposed to it. I don't like this idea of saying, let's put in all these indicators and now let's optimize them all and find that perfect match of indicator variables. So let's say, what's the best moving average? What's the best Bollinger Band that's going to give me the best profit over history? I just think that's such a foolish way of approaching the market. You know, there is an element of where some goal seeking can help, but as technical analysts, we have to understand the indicators that we're applying to our model. We have to know why we're using a 52 period moving average. You know, maybe because there's 52 weeks in the year, you know, or we want to model the average for the last month. So we use a 21 period moving average on daily data. So we've got to understand why we use an indicator, when we use an indicator, and not just try and magically find, you know, the utopian combination that's going to make lots and lots of money in the future. Whenever anybody over-optimizes anything, they're always disappointed in the future. It never carries into the future because they've just made their whole strategy completely path dependent. It's completely dependent on the exact repetition of what happened in the past. And we don't have that, you know. So we're going to talk later about efficient markets, and there's a lot of technical reasons why we would disagree with efficient markets. There's an element of short term where I'd actually do agree with it. I think within the scope of the larger trend, there is randomness about what we're going to expect tomorrow. And so, you know, a little bit of a controversial point there, but anyway, the point here is that we've got to be very careful with these models, that we understand our analysis, we're applying things because we have a rational reason, and we're setting variable lengths because of a rational reason of what we're trying to capture and how it adds to our model. I think I'm just repeating everything that's written there. We've got to ensure that the results of the model are due to most of the signals rather than a few large winners. You know, this is really important in any type of quantitative work. When you've got loss after loss after loss after loss, and then one huge win comes along and makes your system profitable or your model profitable, that's no good, because you can't be sure that that large win scenario is going to happen in the future. You really want to have a model where it's small incremental gains. You know, day after day after day, there's small gains coming from the signals in the analysis that you're creating. Ideally, the model is returning consistent results in all market conditions that it's active in. All right, so that's the model building process. You know, so part of the learning objectives there, you need to be able to describe the use of advisory service opinion and what Ned Davis says there, remembering that all advisors saying the same thing, you know, then we're set up for a reversal. Recognise the difference between sentiment and value indicators. Describe the main tools that the Fed uses, being interest rates and controlling money supply. Interpret the likely results of them changes. What's going to happen? How does that have a flow-on effect to equities? You need to be able to understand that. Identify the outcome of good economic indicator readings and the influence of news and shocks, those sorts of things. News on stock prices. Recognise how moving averages are used in these models as well, and then also recognise how momentum indicators can be included. So, you know, all of those things we've talked about, and we will continue on with relative strength in the next video. Thank you.